Hello, this is Impact Tuition. Welcome to our video on capital reconstructions. In this lesson, we will discuss the indicators of business difficulties, basis of capital reconstruction, the types of capital reconstruction schemes, and capital reconstruction question types. Let's begin. A capital reconstruction is a reorganization of the capital structure of a company. The reasons may be that an entity is in financial difficulties, and as a result, the only option is to liquidate. However, many firms in serious financial positions can be revived to the benefit of creditors, members, and the society. To do this, the entity has to undertake a capital reconstruction scheme. An entity that is also doing well, or a going concern entity, may want to also clean up its statement of financial position, and as a result may decide to undertake a capital reconstruction scheme. Indicators of business difficulties. Let's first look at the going concern concept. The going concern concept assumes that an entity has neither the intention nor the necessity of liquidation or of curtailing materially the scale of its operations. Simply put, the going concern concept means that an entity will continue in operation for the foreseeable future. Certain factors will indicate that an entity may no longer be a going concern. I've listed some of these factors and I've grouped them into financial factors, operating factors, and other matters. We begin with the financial indicators. Where an entity keeps on incurring operating losses, net liability or net current liability position, negative cash flows from operating activities, adverse key financial ratios, default on loan or similar agreements, arrears in the payment of dividends, and capital restructuring, and then non-compliance with statutory capital requirements. These are indicators of business difficulties, and these may also mean that the entity may be facing going concern problems. Regarding the operating matters, the loss of key management without replacement, the loss of a major market key customer, the loss of license or principal suppliers, labor difficulties, and the shortages of important supplies, and then the emergence of a highly successful competitor. Other matters may include pending legal or regulatory proceedings against the entity, and then changes in law or regulations that may adversely affect the entity. These are indicators of business difficulties. So if any of these factors are too adverse, then the entity may consider liquidation or a decision to restructure its capital. Let's continue with the basis for capital reconstruction. First, there must be a real need for the reconstruction to avoid liquidation, and then the reconstructed company must have a good chance of surviving and restoring itself to profitability. For capital reconstruction to be successful, we must take these into consideration. One, all stakeholders must be treated fairly, not necessarily equally. And stakeholders must be offered a deal which is at least as good, if not better, than their situation if the company were to be wound up. Types of reconstruction schemes. There are two types. The first is internal reconstruction and the next is external reconstruction. Internal reconstruction is a scheme designed to restructure the statement of financial position of a company. Internal reconstruction may involve raising new capital, revaluation of assets, the conversion of equity shares from one form to another, deferment of debt repayment, and the conversion of debt into equity. When this is done, the effect may be to reduce the total debt of the company or defer the repayment obligations for other debt capital. In an internal reconstruction, it is normal to scale down the claims of creditors or loan stockholders. We must keep in mind that the scheme must have a reasonable chance of success, and then all parties must be treated fairly. The accounting procedures for internal reconstruction. An account is opened for capital reconstruction, and then into this account will be transferred all shares or loan stock to be replaced. We put through all write-downs and revaluations and expenses of the scheme, and issue new shares or loan stock from this account, and then we transfer the balance of the capital reserve to the statement of financial position, or we write off the balance if it is debit balance against a share premium account or some other reserve. We will put this into practice in our subsequent lessons when we start taking work examples. External reconstruction. This involves setting up a new entity to take over the net assets and business of the old entity. So for the external reconstruction, the existing company is shut down, and then in its place, a new entity or business is set up to continue with the business by taking over the net assets and business of the old entity. Capital reconstruction question types. There are 3 question types. The first is to carry out a capital reconstruction scheme. The next is to appraise a scheme. And then the third one is to design a scheme of reconstruction. With a question that demands us carrying out a scheme of reconstruction, the question must provide a statement of financial position of a company and information about revaluations and capital reconstruction. What we would need to do here is to perform double entry to put the scheme into action, drafting the new statement of financial position. A capital reduction account is used here to process the adjustments to capital, assets, liabilities, and to record reconstruction expenses and any other transactions necessary. Where the question demands an appraisal of a scheme, we must understand that the scheme of capital reconstruction will affect the rights of the various parties who have financial stake in the business, including shareholders, lenders, secured and unsecured creditors. This question type might require an appraisal of the scheme in order to see if it would be acceptable to the stakeholder. The rights of each party might be protected by law such that they cannot be forced to relinquish their rights. Therefore, they need to approve the scheme in order for it to proceed. We must know that each party involved needs to believe that the reconstruction offers them the prospect of more cash or better value than a liquidation of the company. The appraisal of a scheme involves comparing the financial position of each party under these 2 situations: if the construction scheme is carried out and if the scheme is rejected and liquidation occurs. In order to perform the comparison, you might need to construct a working showing how much cash could be raised in the event of liquidation or to whom that cash would be paid. We end with how a question type on designing a scheme of reconstruction will look like. This is a very tricky sort of question to which there would be no single correct answer. A question might provide a statement of financial position of a company and information about the objectives of a scheme. Usually, the starting point would be to construct a working showing how much cash could be raised in the event of liquidation and to whom that cash should be paid. This would provide an indication of which party has the most to gain from the scheme and most to lose without it. The scheme is then designed to take this into account. The parties with the most to gain from the scheme would have to demonstrate their commitment to the scheme by carrying the larger share of its costs. Those who have the next most to lose would then carry a slightly smaller share of the cost, and so on. Those usually affected the most are the ordinary shareholders. If a party is as well off without the scheme as with it, that party cannot be expected to carry any of its costs. So these are the various question types when it comes to capital reconstruction. In our next video, we will begin by looking at an example, a worked example on carrying out a scheme of reconstruction, and then we'll also look at appraisal of a scheme and then designing a scheme of capital reconstruction. Thanks for watching. See you in our next video.